Meta or Facebook stock absolutely collapsing, losing about a quarter of its value today. The question is, how bad will it be? In this video, we're going to talk about their third quarter earnings results. And is this actually a potential opportunity for investors, or is this just the beginning of a continued decline in Facebook stock, which is absolutely brutal, losing a quarter of its value? In full disclosure, I own a teaser position in Meta stock. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of subscribing to this channel. So let's understand what's going on. Is this an absolute disaster, or is this an opportunity for shareholders? Well, first of all, you should understand there's about a 5% revenue decline from around $29 billion last year to around $27.7 billion in revenue this year. But worse, their core profitability has declined by 50% plus, from $9 billion to around $4 billion. Investors do not like to see collapsing profitability. So let's understand what's actually going on from a top level perspective. Why is their advertising revenue declining by a couple percent? So you have a couple of different pieces. First, down about 4%, but up 3% on a constant currency basis. So effectively, the US dollar is strong. They have a lot of foreign business. And as the US dollar appreciates, those foreign sales become, that foreign advertising business becomes worth less, not worthless, worth less. And it's compounded by the fact they also have a lot of operating expenses in the US. So as foreign currencies lose their value relative to the US dollar, you not only lose your revenue impact, but you also see a pronounced impact in terms of your profitability. So that's a good part of what you're seeing. They did make the point that saying, hey, the nonsense from Apple with their new privacy policies, that actually had a diminished impact on the quarter. In the previous quarters, you'd notice a real headwind, but what they did call out was that they're starting to see weak advertising demand, which they believe is, due to the macro uncertainty and volatility, saying healthcare and travel was strong. YouTube had talked about, with Alphabet's earnings, they had talked about how travel and retail were strong, but they had talked about how online commerce, gaming, financial services, consumer products were weak. In all honesty, I view this sort of early advertising results, both from Alphabet and Meta, as sort of the canary in the coal mine of what's to come with the economic cycle, because you saw the initial tightening from the Federal Reserve. So what are the first impacts? Well, the first impact, is higher interest rates. So not surprising that both YouTube and Meta talking about weaker financial services advertising revenue. That's because, hey, you're not going to see loans get pushed as much, or you're not going to see crazy crypto products pushed as much in an environment with real interest rates. And that's where we are now. Not surprising to see weakness in the financial services sector. Another reason why, let's say, online commerce is getting hit, that's because of the inflation aspect. So that's because when you're thinking about a consumer having to make a choice between some fidget spinner that they're going to buy online and having to pay their rent or buy food, and they're like, yeah, I got to buy my food. And so that's what's going on broadly with online commerce or e-commerce or consumer products as well, is that what you're really talking about is discretionary goods are falling to the wayside relative to things like, energy costs and costs tied to shelter costs. And what you think about in terms of getting their figures is that they increased the number of ads that were effectively shown to around 17%. That's showing folks more ads as well as more people on their platforms, but the average price per ad decreased by about 18%. So that, when you multiply those two things together, that actually nets out to about 4 or 5% decline. Now, this is made even worse by the fact that, yes, their family of operating, their family of apps, their advertising business, historically generating a lot of profit, that declined from 13 billion to 9 billion, but their reality labs, this metaverse, is actually worsening losses. And investors are really not liking to see this. They're saying, Zuck, what are you doing, man? Like, I live in reality and you're spending crazy my reality bucks for this metaverse. Like, what's going on? Like, and you're seeing, I'd argue you're seeing like real frustration. Like, you got these super voting control shares. Like, this is ridiculous. And, I'm thinking about it, and it's like, it's made even worse. And you truly can get capitulation from investors where they're like, screw this. I don't need to be part of this metaverse, when They're like completely making tone deaf comments like, we expect Reality Labs expenses will increase meaningfully again in 2023, with the biggest drivers of that being the launch of the next generation, Quest headset. Part of that, however, is due to the fact that they've made new hires. And so those new hires, well, they only recently started paying the full salary. So the full salary will be reflected in 2023. And still, either way, I mean, this does create the risk that Facebook could actually operate at a loss potentially in the year ahead. So we'll see, depending on how bad, let's say, the advertising environment looks. Now, management did say, hey, our goal of achieving, broad company operating income growth beyond 2023 is still their goal. And they are thinking from a capital allocation perspective, look, some capital is going to go to, let's say, some of these future focused areas, but they are still going to return capital to shareholders. So we'll see sort of how that plays out. Will they even have the free cash flow to do it? Their cash flow previously was around $10 billion a quarter, looking at $40 billion in free cash flow in 2021. This is back when the company traded around, trillion plus valuation. Now their free cash flow in the most recent quarter was closer to break even. That is sort of what is that? Like, how did you've got $4 billion to nothing? Like, that's a big problem. Like, you won't be able to do buybacks if you're going to cash burn. And arguably, we're not even in a recession yet. So what are they even investing in? Well, they really have three main things that they're investing in. Is AI discovery engine that's powering Reels. That's their competitive product to TikTok. Their ads and business messaging platforms. And they talk about how that's rapidly growing. And their future vision of the metaverse, which we've talked about before. And a lot of people are like, what are you doing there? So the question is, what happens to Meta stock from here? Where do I think it potentially goes? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And full disclosure, this is not financial advice, and I do own a little teaser position in Meta stock. So when I look at Meta and I look at this collapsing share price, I look at their collapsing earnings, the reality is it's not all absolutely terrible. Their core family of apps, the number of users, is up to nearly 3 billion on a daily basis, spread across Facebook, Instagram, WhatsApp, what have you. That's pretty incredible. Still growing on a global perspective. Even their legacy blue app, Facebook, is still growing on a global basis, and the most mature markets are flat. US is flat year over year. Europe, you do have Russia aspects, but still, that's pretty flat. It's not like it's rapidly declining. And the rest of the world is expanding. So this is really interesting when you're thinking about, well, what's the core earnings power long term? And so there were several comments that actually make me optimistic about Meta in the future. And this is something that I think it's important for investors to think about. So one is Reels, which is once again their TikTok competitive product. They're playing that across Facebook and Instagram, 140 billion Reels per day, a 50% increase from 6 months ago. And they're saying it's incremental time spent on our app. So it's not sort of cannibalizing their existing users. They're engaging users more. Users are spending more time, and they're saying we're gaining time spent share on competitors like TikTok. This is a reversal from where they were a few months ago. This is a really actually very, very positive data point. They're effectively saying our core business is getting more engaging by sort of interspersing AI-generated content of like, hey, here's a cool cat video with, hey, this is what happened with your aunt, and interspersing content that from people that you know and you don't know, and sort of saying, hey, this is actually much more of an engaging app, and you're going to use it more. And if you're using it more, there's going to be more advertising. So that does strike me as like, hey, your value proposition actually got stronger. That's really interesting. Now we're developing a flywheel between discovery and messaging that are going to make these apps even stronger. So this is another aspect that I didn't consider, which is that, hey, by having this viral content that you then want to share, a lot of people are now posting it in WhatsApp. On Instagram alone, people already reshare Reels, a billion times a day through direct messaging. So WhatsApp or Instagram, well, people are saying, hey, I'm going to share these moments to make it even more engaging. And so it's interesting to see that. And then he also talks about arguably incredibly fast growth with some of their click to messaging ads in Messenger and WhatsApp or Instagram Direct, where WhatsApp just passed 1.5 billion run rate and growing more than 80% year over year. I mean, that is clearly resonating, taking market share. These types of products that click and resonate with businesses and consumers, sort of the ease of doing things. Okay, so where does Facebook stock go now that it's around $105 a share and down significantly from its $1 trillion plus valuation? Now it's sub $300 billion. Well, I think it's not productive to try to say, hey, what's the free cash flow in the next quarter, or where do they look like next year? Really, because this picture is so muddied by these investments they're making and potential recession, I think you need to mentally just sort of scrap what it looks like this next year or two, because arguably they could get into a cash burn situation, in which case, are they even buying back stock? Like, it'll be a lot tougher for them. They do have 40 billion in cash on their balance sheet, but they also borrowed money for the first time to sort of, I think, so they didn't have to pay taxes on some of the cash that they have, so they don't have to repatriate. That's what I suspect is going on. But looking at this, looking at the setup, their free cash flow is collapsing, their profits are collapsing, but their historic profitability was around 40 billion in 2021. Peak profits, 40 billion, and it was around 40 billion in free cash flow versus around 280 billion market cap. So what you're really saying is 7 times peak free cash flow. So what you're really asking yourself is, has the core business deteriorated? I would say you're looking at a cyclical aspect that is deteriorated. You're looking at a weaker advertising environment. That's interesting. But the core, in terms of the value proposition for consumers, has actually gotten stronger recently. Talking about taking share versus TikTok. And by the way, yeah, I'm a believer that one day we're going to wake up and TikTok's going to be banned, but that's a whole separate other conversation. It makes zero sense for the U.S. to continue to allow TikTok in the United States, in my opinion. When China allows Instagram and Facebook to be in, there, then I think you'd consider it. Until then, it doesn't make any sense. Just from a pure reciprocity perspective. Even beyond national interest perspective, and potentially, who knows what messaging comes across there. As you can tell, I'm a big TikTok user. And so looking at this, I'm thinking 40 billion was their peak. Is it possible that in the years ahead, they can get back to 40 billion? Is it possible they get back to more? And so if they get back to 40 billion plus in the years ahead, now keep in mind, Reels is monetizing at a lower rate than some of their other ads. So that is sort of a headwind, if people are spending a little bit more time there. But thinking long term, as long as users are still spending time, as long as there's going to be effective ads in front of the users, I think long term, it's very possible they get back to that 40 billion in free cash flow. In which case, 7 times free cash flow will be very, very cheap. And you could potentially see a re-rating to 15 times. So an easy double, which, by the way, if, Zuck intelligently is able to buy back stock at these prices, and he's been rapidly buying back some stock, but if he's able to really gobble it up, retire, let's say 10% a year for a couple of years, then it could be really interesting. Then you could be talking about, hundreds of percent upside, if you have that type of return to shareholders. And so it's really challenging because you have this huge bet on the metaverse, which I'm not certain about at all. You have the declining free cash flow picture, and arguably just the beginning of a weakening in economic environment. So I personally look at this and I think, more pain potentially to come, at least from a fundamentals perspective. I'm not really inclined to buy. That's for sure. I'm sure there'll be some value investors that are like, this is it. I'm gonna make it 20% of my portfolio because 5 years from now they'll be back at 40 billion in free cash flow. And I can't argue with that perspective. And there's a good chance they make money on that. I also think that there's a possibility that you wake up and one day it's trading at 3 times prior peak free cash flow, just because the advertising environment has gotten even worse. The economy's right now they're just dealing with the impact of inflation. Like, what happens when the broader economy is worse. So if they're dealing with the impact of inflation and higher interest rates. Like, what happens when the broader economy is worse? And let's say revenue declines by 10%. And then he's like, oh, snap, we really do have to do layoffs because we're cash burning. And like, hey, we don't want to go broke. In that situation, then you could probably get this really, really cheap. So maybe I'm being too greedy here. And I'd absolutely love to hear your thoughts on this, because some investors, I'm sure, will be like, this is awesome. I can buy Zuck for 7 times free cash flow. I'm thinking, well, it's not really 7 times free cash flow because, you have this huge bet on the metaverse that has gotten scaled up. But there's also the possibility that Zuck is not completely nuts. And he's going to wake up one day and either the metaverse is taking off, which I don't think you're going to see in the next, let's say, 3 years. Or, so either the metaverse takes off or he wakes up and is like, what was I doing? Like, that was kind of crazy. That you guys remember that time I spent $10 billion a year on the metaverse? Yeah, that was kind of crazy. And I didn't even have legs. So I look at this and it's like, there's a possibility he wakes up one day and the stock goes up 50% because he's like, yeah, sorry for the psychosis. Like, it's all good. We're going to move on now. We're going to forget about that period of me talking about the metaverse and just focus on being an awesome advertising business. Like, if he spun off the Reality Labs business, gave it all of its cash, and created 2 separate companies, there's a good chance the total value of the 2 entities would be worth more than it is today. Thinking about it. Anywho, if you enjoyed this video talking about, thinking about Meta, where's it going? Like, I personally, it wouldn't surprise me to see it a lot lower. It also wouldn't surprise me to see it a lot higher. And that's part of the reason why it's not a high conviction bet for me. It's not like when I make a large bet for my personal portfolio, Warren Buffett once termed the idea that he wanted to find the inevitables. He wanted to find the things that were really strong probabilities that it would work out over time. And I look at this and it's not really strong that it's going to work out over time. There's a lot of ways that this can go wrong. But by seeing that traction with users is increasing, that actually increases the odds of this inevitably working out. So I do like that. But seeing how capital is being allocated and that the metaverse is sort of like, seems to be just a giant pit at this point. It's cool, don't get me wrong, but I don't think it's truly world changing. And look, I hope I eat my words. I hope that someday it truly is revolutionary and it's awesome. So far, I don't quite see it. But in that scenario, like where it proves to be awesome, then it's like, oh my gosh, then the stock is up like 500% from here, if that plays out. So there is tremendous, and this is why I own a teaser position. It's like the worst that could happen is with any stock, the worst that can happen is you lose 100%. The best that can happen is like, hey, I can make several 100%. So that's why I have a teaser position, but it's not inevitable. It's not inevitable that this doubles or triples. The things that the inevitable, quote unquote. So my top positions, which I call out to my Unrivaled Investing subscribers, that's going to be the things where it's like, I have higher conviction that this is going to work out because the capital allocation makes sense and I understand what they're doing and the growth is there or the valuation is there and the things are more aligned that I'm not going to wake up and say, hey, there's a permanent impairment here. Whereas here, there's still that risk of a permanent impairment just because how bad does their environment get this next year, and do they actually start entering a cash burn sort of risk? So that is a risk of permanent impairment. It's not super high. I'm walking through the thoughts here because the truth is the core value proposition is stronger than it's been with number of users, I would argue. It's just the capital allocation and the macroeconomic environment that's a challenge for it. So you can see it's a very tricky picture looking at it. Anywho, I hope this video has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button, and thanks so much for watching Unrivaled Investing.